The latest inflation numbers are out, and they show the problem is getting even worse. Is relief from these rising prices anywhere in sight?
Inflation is going to keep going higher. It may not go to 12%. It may be eventually go to 5%, and then it'll be back at 7%, and it'll fluctuate. And and if it completely goes haywire, it could go double digits. But until that inflationary mindset is broken, inflation will not seriously go away. It just can't.
Welcome to Wealthion. I'm Adam Taggart, founder of Wealthion, here with an interview on a particularly timely topic for today's investors. Inflation is really starting to bite. The latest consumer price index was released last week, coming out at 6.8%, the highest inflation rate the U.S. has seen in 40 years. Households pinched by these higher prices are asking, when will this stop? Well, not anytime soon, says macro analyst Wolf Richter, who just issued a report warning that getting inflation under control from here will be both a difficult and lengthy process, especially as it's being managed by, quote, the most reckless Fed ever. Wolf, thanks so much for joining us today on such short notice to talk about this.
Thanks for having me back, Adam.
Hey, it's always a pleasure, Wolf. So, in the intro there, I was more diplomatic than you were in your title describing today's situation. That your report, which I've got here and I'm looking forward to walking through with you, is titled "Whoosh: Shock and awe loss of dollar purchasing power hits Americans. Worst inflation in 40 years. Getting it under control will be a bitch." I want to walk through the many charts that you've gotten there because I think they're really useful in helping people understanding just sort of how intense things are raging right now. But before we do, for those who haven't been paying as close attention as you and I to the situation, can you just give a quick summary of how we got here?
Yeah, so I think there's a fundamental issue here, and that is that after 10 years of interest rate repression and many years of those 10 years of money printing, there really hasn't been a lot of inflation. And in Japan, it's been 20 years of 0% interest rates and lots of money printing, and there hasn't been a lot of inflation. And the same thing happened in Europe. They started money printing and repressing interest rates and negative, and there wasn't a lot of inflation. And so this gave central bankers, especially the Fed, the false confidence that they could print $4.5 trillion in 20 months and repress interest rates to zero. And at the same time, the government spends $5 trillion in deficit in borrowed money. And so you have this $10 trillion of stimulus in the United States. And there was this false confidence that inflation wouldn't react, the prices wouldn't react to it as kind of that they expected us to go forward like it had been in the past 10 years. And something fundamentally changed, and it broke that dam. And now suddenly prices all over the place across the world are surging more or less fast. In some countries a lot faster than in others. The United States it has now a higher inflation rate than Mexico. So I mean these are issues that none of the standard economists expected to have a year ago. And I've been saying for years, at some point you can't print money like this forever. But this is the situation we now have. There's a dam that broke, and something fundamentally changed. And now we have this enormous amount of stimulus that is creating an enormous amount of inflation. And I think that's the situation roughly. We're looking at. Everybody's surprised. Now the Fed's surprised by this, and the Fed has been incredibly reckless in ignoring the past 12 months of inflation and continuing to fuel the fire with money printing and interest rate repression.
Okay, thanks. And it's funny you say everyone's surprised. I don't necessarily think guys like you and I are surprised, or probably many people who watch the Wealthion channel. We were the ones who were watching the trillions and trillions of dollars getting pumped out, both by the Fed in monetary stimulus and then by Congress issuing even more than that in fiscal stimulus over the past 18 months. I think we were worried that something like this might happen, but it's happened. The inflation genie is now out of the bottle, as you said. So let's dial through your charts here, and then we'll get to your final conclusion as to why all the data we're seeing, in your eyes, it's something that's not going to be able to be, resolved anytime soon. Because I think a lot of people are, wrestling with that question is, hey, gosh, I hope this isn't going to last very long. Sadly, I think it looks like it very well may be something that's going to be with us certainly through 2022 and maybe a little bit beyond. Let's start here by putting up just the CPI numbers that I mentioned at the start. Latest print is at 6.8%, and you can see here from the chart that height hadn't been reached since 1982. So it's really been a full 40 years since we've seen inflation rising this high. But you mentioned it's sort of different this time because in 1982, the Fed was tightening rates. Interest rates, I think, were still at like 13% back then, where today they're pretty much close to zero. And inflation is on the rise here. It's we're still probably in the process of the surge. So how is today different and maybe in worse ways than it was 40 years ago when we were at the same level?
Yeah, so 40 years ago was the down phase of that inflation spike that had started in the 1970s. So yeah, we're looking at roughly a 10-year surge in inflation. And so 40 years ago, we were on the downward leg of it when after Volcker had already raised interest rates. Interest rates were coming down at that time. He'd raised them, close to 20%. And then by 1982, it cut them. But they were still at like 13, 14% in that time period. So they were very high, and there was no money printing going on. Now we have, and so the real interest rates were positive across the spectrum 40 years ago. I mean, there were higher, interest rates were higher than the inflation rate. Now we've got, close to record low interest rates or record low interest rates, and this huge inflation. So we've got this enormous amount of real negative interest rates. And that's incredibly stimulative. And what we had in 1982, they were cracking down on inflation still. What we got now is incredibly stimulative still. We're on the upward leg of this thing, and they're still stimulating. So there's a huge difference between these two scenarios. We're kind of now where we were maybe in the 1970s, and on the way up. And even then, though, interest rates were always much higher in the 1970s. They were never 0%. And long-term rates were much higher, and it never had this kind of distortion that we now have.
Yeah, your note here mentions that pretty much all interest rates and yields right now are negative, even on junk bonds, right? Which should have the highest rates because they're the riskiest, but their real rates, when you subtract the inflation rate from them, are still negative, which is kind of mind-blowing in a lot of ways. Also, too, just to underscore your point about, we're still stimulating. We're hearing the Fed talk about getting more aggressive and accelerating its taper plans. And there's chatter about, are there going to be interest rates hikes, perhaps, maybe, in late 2022 or maybe 2023. But right now, the Fed is still pumping a bunch of money into the system. I think in the mid-November through mid-December timeframe, they're putting something like 105 billion. They're still conducting in asset purchases.
Yes, and tapering is not tightening. Tapering is reducing the amount of fuel you're throwing on the fire, but you're still, like you said, you're still throwing this fuel on the fire, and it's just reckless. And 0% interest rates when inflation is near 7% is incredibly inflationary and incredibly stimulative. So you have both these factors, and the Fed isn't even discussing raising rates yet. I mean, they're going to do it, but that's maybe at this meeting they'll come out with some guidance on rates. But so far they've said no, we're not going to even talk about it. It's too early to talk about raising rates, and so I mean they're going to reduce the amount of fuel they're throwing on the fire by a larger amount than they had previously said, but they're still throwing fuel on the fire.
Yeah, that's just crazy. You're talking about how the fire you've made is too big, but you're still tossing logs on it while you're making that claim. All right, I want to put up a chart here now of CPI-W, which is the Consumer Price Index for all urban wage earners and clerical workers. It's another way to measure the inflation rate. But what's material about this one is this is what the Social Security cost of living adjustments are based off of. And this is even higher than the 6.8% that I mentioned earlier. This is at 7.6%. You note here in your report too that this is exceeding even Mexico's soaring inflation rate, which, that's not company you want to be in from an inflation standpoint. But how significant is this in the fact that this is actually the benchmark by which COLA adjustments are made by?
Yeah, so the COLA adjustments are made based on the average in the third quarter. And we had the largest COLA adjustment in decades this third quarter, but they're already outrun by this inflation by a full percentage point. So the COLA adjustment for next year was fixed in the third quarter. So next year's third quarter of CPI-W will fix the COLAs for the following year. And the thing is, these COLA adjustments on the way up, I mean, they seem to be big, but by the time they implement it, they're already behind, and retirees are already getting whacked by this inflation to a very significant extent, and future retirees too, because this is cumulative. Now, this is Social Security. COLA adjustments are changing all future payments for everybody. So even people who are just now paying into the system. And CPI-W, I actually think that's a better indicator than the CPI-U, the headline indicator. It shows a little bit more realistically, because CPI is still understated by many factors that we go through, and so the actual inflation that personally people feel could be far higher than what any of these CPI numbers are saying. So it's another official inflation statistic that is a little bit more realistic, I think, than the headline CPI-U figure.
Okay, and I do want to dial through those indicators that suggest that the reality people are experiencing may indeed be worse than just these numbers. So just want to revisit one point you made here, because I think it's really important, especially because we have a lot of people who are retirement age or getting close to it who watch these videos. The Fed policy to date has really punished these people already, because low interest rates have basically made it impossible to retire on a fixed income the way that previous generation of retirees did, right? When bonds are yielding next to nothing, when you're getting nothing in your bank savings, you can't retire the way that people were planning on. But then inflation is a twin insult on top of that, because even the little bit that you have, you're getting in yield. It eats away at the purchasing power of that money, and therefore all of a sudden you need a lot more to retire than you thought you needed to, right? So it's a big issue. I'm going to put up another chart that you mentioned here. It's the core CPI-U, which basically takes out food and energy, and of course we like to laugh when they do that, because they sort of imply that, well, we're all doing fine except for food and energy costs. And it's like, yeah, but we need those to live, right? But I think what you're making here with this chart is, this chart also shows a big spike. It's now spiked up to almost 5%. You're saying that this is showing that inflation is beginning to creep out of just essential goods and into services as well, which is sort of an indicator, and correct me if I'm wrong here, but it's sort of an indicator that inflation is kind of getting out into the full system, right? So you could sort of hide behind, hey, we have these near-term short-lived breakages in supply chains, and once they come down, goods will get cheaper again, maybe. But if we see it going into services, that's not dependent upon supply chain. That's just becoming sort of intransient, permanent type of inflation. Is that all correct?
Yeah, so the services segment of inflation is the larger part of the CPI, and a third of CPI is a housing component that is based on rents, and they're using two different rent approaches to figure the cost of home ownership and then to figure the cost of renting. And we have all known, that house prices have shot up. Case-Shiller says they're up 20% and year over year, And rents are, by other measures, so this is asking rents will be up 10%, roughly 11% year over year, depending on, in some cities they're up a lot less, but in others they're up 20, 25%. Yeah. And so these figures are slow in making it into the CPI calculations for how the CPI is constructed, the types of surveys that they're surveys that they're using for that, and these are huge surveys, and they have a panel of households that are asked twice a year, and these same households get the question twice a year. So it rotates through, and it takes months to catch up. Well, they started to rise in the CPI, and they're still very low. They're still at 3.5%. So they're actually lowering the CPI, but they're surging. They're going up now, and we'll see them go up next year as they're catching up with the reality. And so we'll see these housing components go to 5, 6, 7% next year, and maybe higher. And that's at 1/3 of CPI. And in reality, we're looking at rents that are increasing faster and house prices are increasing faster. So it's just now catching up. But these have been, in the past few months, these figures, these housing components have repressed CPI. And they're going to stop doing that. And they're going to hit, these new highs that we're seeing. And so this is 1/3 of CPI that is now waking up. And just the way it's structured, we know already, regardless of what happens in the market, we know already that in the first half of next year, those numbers are going to surge based on what happened so far this year. So, this has nothing to do with supply chains and bottlenecks and transportation problems and port entanglements. This is just pure services. We have seen this in numerous other services and services I'm looking at from my little company. Everything is up by the double digits. These are just services not involving any goods. Many other businesses are seeing that. Consumers are seeing it. So we've got Medicare Part B premiums. That's a service. That went up 17, 18% year over year for next year. So it's going on everywhere. These are services. Nothing to do with supply chains and bottlenecks.
All right. So kind of punchline: inflation's becoming pervasive and sticky, right? So big concern to everybody. It's not just coming in real estate, but I do want to re-emphasize your point there that to date in the CPI numbers, as largely as they've spiked recently, real estate's actually been a drag on that CPI number. And you're saying it's about to flip to, instead of being a drag, it's going to start pushing it even higher. So, concerning. Let's go to some of the other things that you said. You're saying, look, this is, you look under the hood, it looks even worse, right? So food costs, they are up over 6% year over year. Looks like the CPI for meats has jumped by 16%. And I think anybody shopping, anybody watching this has gone to the store to buy food. They've seen, in many cases, this, I would say for me, at least, it's on average, it's a double-digit increase. I think it's higher than the 6%, at least for my family's household budgets. The big one, though, is energy costs, right? So that is up 33% year over year in aggregate, but gasoline is up almost 60% year over year, which is pretty massive. And for people that have to commute for a living, like that really does pinch household budgets. Natural gas to the home is up 25% year over year. So these are real essential inputs in people's lifestyles that are going up by relatively material high double digits. I don't know too many households before COVID hit that could absorb these types of prices. And as you said, these don't look like they're going to be slowing down anytime soon.
Yeah. We complain about gasoline prices and oil prices, but oil has actually, it's pretty cheap still, It's not the crude oil prices that are pushing up gasoline prices. Crude oil is where it's been a couple of years ago. it hasn't. It used to be $150 a barrel for West Texas Intermediate, during the last surge of inflation in 2008, and now we're looking at in the $70 range, and so that's really, it's pretty cheap. It's the level where frackers in the United States can barely make money. I mean, they're starting to be profitable at that rate. What has happened is that the entire chain between crude oil wells and gas pumps is reaping massive profits out of this. So it's the refiners and the distribution channel, the retailers, and all those. And this is what we've seen everywhere. Everybody's raising prices and they're getting away with it. And that's a big change in the mindset. And so now we've got incredibly profitable middlemen there, and we've seen the same thing in with beef, for example. The meat packers have historic profit margins now because they're getting away with it. People, consumers, are paying those prices. That's the mindset we've had. That's the dam that broke that I was talking about earlier. People are still buying meat at those prices. They're still getting gasoline at those prices. Of course, gasoline is not a discretionary purchase. You can buy. You can become vegetarian and not buy meat, but if you commute, you're going to have to buy gasoline, and so this is a bigger issue. But even now, gasoline is on a long-term scale. It's below where it was 10 years ago, and so those prices could go much higher. This is not like a price spike like we've seen in lumber or other things. Oil hasn't gone up that much. Oil is still fairly low, and gasoline prices are still below where they were 10 years ago. So we got to keep in mind that this is not some historic price spike. This gasoline is, that can go higher. That can go a lot higher. And I'm not saying it will. This is kind of one of those commodities where where there's a lot of supply that can come out of the woodwork very quickly, and we'll have to see how that turns out. But the crude oil is, the fact that it's not expensive, that you're talking about the middleman making the profit and the middleman contributing to inflation, that's a different issue than a commodity price. Now this is a service providers, that the refiners and the retailers and the channels in between, that are triggering this inflation in gasoline prices. So this is a different issue, and we've seen that all across now, that there's just no price resistance. Nobody's fighting back. Everybody's just paying.
Well, and I want to get to this more deeply in just a moment here, but the danger here, right, is that people adopt an inflationary mindset, right, which says I should. Well, let me do this. I'm going to put up a chart here from your report that shows the decline in the purchasing power of the U.S. dollar since the year 2000, and it's lost. Basically a dollar purchasing power back then only buys you about 61 cents today. So the challenge with inflation, the danger of inflation, is that people begin to sort of lose confidence in the currency, and they develop this inflationary mindset where I better buy everything today because my dollars are going to be worth less in the future going forward. Of course, that's the big main factor in a hyperinflation, is that people just can't get rid of their currency fast enough, and it creates this vicious spiral. I don't know if we're exactly there yet, but that is part of the concern here, right? Is that people are adopting an inflationary mindset. They're thinking, just like Powell, I guess it's not going to be transitory, and therefore I better buy today versus buying tomorrow. Correct?
Right, and we've seen this in the housing market. We've seen it now in the vehicle market, new and used vehicles. I mean, this is one of the most incredible things I've ever seen, and it's just completely nuts what's happening there, and people go with it. I mean, that's the thing. They don't have to buy a car. They can just wait a year, drive what they have, but they're not. They want to buy now, and so that they don't have to pay the higher price 6 months from now. And exactly like you said, it's an inflationary mindset has completely changed. Now, gasoline is non-discretionary, and people are sort of forced to pay for it, and they can't really hoard it. So this is a little bit of a different ballgame there. But the discretionary purchases are where we're seeing this. And a lot of services are discretionary, and people are paying for it. And it's exactly that. It's a change in mindset, and it will impact anything. This will bleed through.
Right. And it's funny because sort of fear of higher prices tomorrow in many ways kind of creates higher prices tomorrow by people rushing in today and jacking prices up. Right. And you mentioned the auto industry. I just want to put up the two charts that you had in your report, because I think they make the point very effectively. The new vehicle price has spiked. It's now up over 11% year over year. That's the highest it's been since 1975. And people watching this, there are folks that remember the inflation back then to the mid 70s. But gosh, that pales in comparison to looking at the prices of used cars. They're up 44% from a year ago. I mean, that's just a mind-boggling increase for a product like this, especially as you're saying, people could wait. Now, of course, this is exacerbated by the supply chain issue. We had you on a few months back talking about the impact of the bottlenecks. And of course, the auto industry has been hit particularly hard by the chip shortage because today's cars rely on a whole bunch of different chips for a whole bunch of different functions. And those chips come from different vendors. So it's a very complex issue. But I got to say, looking at that 45% price spike, I mean, it's just nuts. So I guess coming to the end of your overall report here, Wolf was saying that, to use your words from the title, like this is going to be a bitch to get under control, right? We have we have the Fed running this, which you call the most reckless Fed ever, and I want to let you opine over that in just a moment. But as I see it, there's sort of two factors at play here. There is really there's a policy side. Right, we can say, look, this is, a lot of this inflation was caused by the policies of the Fed issuing too much monetary stimulus and then Congress issuing, even more fiscal stimulus at the same time, so flooding money into the system. But we also do have a supply issue. We've got some short-term supply issues created by the supply chain breakages. But we also have a lot of these industries that have been underinvested in CapEx. And, Rick Rule talked a lot about this, saying that, he foresees a number of kind of core commodities going up substantially in price, even if demand doesn't really change very much going forward, just because those industries have been so CapEx starved that there's just going to be less of this stuff around. So to me, that does sort of set a landscape of really, concerning and potentially intractable inflation, for a while. Anyways, I'm gonna hand the football back to you, but explain in your eyes why this is going to be so hard to undo.
Yeah, this is going to be a very tough job for the country, really. I mean, that's what I mean by this is going to be a bitch. This is going to be hard to do, because the thing that the Fed will have to do is to break the inflationary mindset. And it has to credibly come forward and say, we're going to raise rates and we're going to run off our balance sheet until we get this inflation down. And the way you get inflation down is to reduce demand, and reduce demand far enough to where everybody realizes, okay, I can't raise my prices anymore because people aren't buying anymore. I have to stop raising prices, and people have to refuse to buy at higher prices. So you have to make it more expensive to purchase on credit. You have to sap the confidence of businesses and individuals in this inflationary trend. The people, businesses, and consumers have to believe that next year things are going to be no more expensive than this year, or maybe cheaper, and I better step back and better not buy, better not consume. And that's what brings inflation down. But this is a bitch. This is hard to do because you're looking at a recession. That's when you have a really big bout of inflation. That's how you deal with it. And in the past, before we had central banks, that's what naturally happened. So there was a natural business cycle, and there were excesses, and there were inflation processes on the way, and and then the business cycle would turn, and then credit would get more expensive, and businesses would go bankrupt, and the investors would lose some money, and that debt would get restructured, and demand would go down a little bit, and then inflation would disappear. And this cycle has to play out for inflation to go away. And Volcker did that. He triggered the double dip inflation, the recession, and it broke the back of inflation for 40 years. That's what that accomplished, because people were had the confidence that inflation would not be an issue, and that next year goods would be just a little bit higher than this year, and there was no sense in binge purchasing. And if a company tried to raise prices, you go somewhere else and you shop somewhere else, and you get this price conscious mindset that blocks inflation from going up. And right now, this has just completely gone away, and so to reestablish that inflation, to break that inflationary mindset, and to reestablish the price consciousness that businesses and consumers used to have, that's not automatic, and that's what is needed to get this inflation under control. And all this stimulus, what it did was it created this huge amount of demand, and when there were normal supply chains, they weren't ready to deal with this demand, and that was a one-time event, but that broke the dam. That was what finally changed the mindset, and we've seen that now. So we've seen the results. Now it's a psychological issue, and it's not a supply chain issue anymore. If people went on a buyer strike and refused to buy vehicles, which they did during the Great Recession, suddenly the car dealer lots are filling up with cars, and they're starting to have to offer discounts, and back then the industry collapsed because consumers refused to buy cars for several years in a row. And now we have the opposite. And the Fed needs to get back to this Volcker philosophy that you need to break that inflationary mindset. You need to have consumers and businesses resist price increases, and that's what finally gets inflation under control. And consumers and businesses will have to say, no, I'm not buying this at this price. I'm going to wait. I'm going to look for a cheaper competitor. And then there is price resistance in the system, and then you get inflation coming down. Until that happens, inflation is going to keep going higher. It may not go to 12%. It may be eventually go to 5%, and then it'll be back at 7%, and it'll fluctuate. And and if it completely goes haywire, you could go double digits. But until that inflationary mindset is broken, inflation will not seriously go away. It just can't.
Okay, so here's where it gets really interesting. So we know what we need to do to break that mindset and to get inflation under control. And there's a Volcker, rule book for that. The question is can we? Right. So look, the administration's finally woken up to this. This is becoming a big political issue for them. 2020 is an election year. A ABC Ipsos poll came out yesterday that showed that 69% of voters disapprove with how the Biden administration is handling inflation. And I think that's probably one of the reasons why the Fed is now talking so much about accelerating the taper and maybe rate hikes, is they're getting a lot of political pressure to get this under control, right? But we have financial markets that are completely addicted to low rates and tons of stimulus entering the system. And so, reversing course, like the Fed's now talking about, that could puncture this asset bubble we have here, right? We also have a record number of leverage in the system, right? So higher rates alone could start killing a ton of companies that can't afford their debt services at much higher rates than we are today, right? And that triggers the recession that you mentioned, which has job layoffs, right? Which just exacerbates the pain that people feel. Right. So we know we need that tough medicine, but the system is so unstable right now. A lot of people balk at the cost of what that medicine would wreak across the system. And we saw, the Fed tried to get serious about tightening briefly back at the end of 2019. And then we had the infamous Powell pivot, right, when the markets threw a hissy fit and he just reversed course. Can the Fed stick to it this time, or will the pain of the taper/tightening be so much that the Fed is really, I don't know, stuck in a position where it's got to deal with inflation, but it doesn't want to break the system and doesn't know what to do?
And so the amazing thing with the labor market is that we have these huge labor shortages right now. And there's lots of people here in the United States that used to work, that could work, who are not working. So companies cannot fill vacant positions. There's 11 million open positions in the United States right now, and a historic number. And so when demand goes down a little bit, enough to eventually cool inflation. We're not talking about a collapse in demand. We're talking about just demand tapering off a little bit. That means that the labor shortages might just become a little smaller. Nobody's talking layoffs right now. I mean, they're looking to fill 11 million jobs. So when businesses are saying, okay, we don't really need, so one business says we need 100 people, but if demand goes down a little bit, they might not need 100 people. They might only need 50 people. And so, the job openings might go back to some kind of normal level if demand goes down, rather than being at this extraordinary high level. Also, a lot of people are not going back to work because they made tons of money in cryptos and in stocks and in real estate, and they're just resting on their laurels, and they expect to make 50 or 100% next year and all years in the future. And so there's no logical reason for them to go back to work. And we've seen that in 1999, and I was part of that group, and at least I traveled around the world for 3 years, but when the market crashes, so the NASDAQ back then went down 78% and the S&P 500 went down 50%, and all those people that were enjoying, spending more time with the day trading activities, they weren't enjoying that. They lost a ton of money. They lost everything they had, and they went back to the workforce. And now we have a lot more of that. We have bigger bubbles. We have the crypto bubble. There's a couple of $1 trillion involved in that, and we've got a whole bunch of other things that have supported people who don't want to work anymore. And so when these asset bubbles go away, what you will see is that some of the smartest people out there are rejoining the workforce, and that's a good thing. They've exited the labor force because they didn't think they needed to work, and when the asset bubbles come down, that brings these people back into the labor force, which will be a great thing for the U.S. economy. To get these people back to do productive stuff. And, my recommendation for Powell would be, if he really needs to fix the economy, he needs to crash the markets so that people who decided to ride up the bubble, that they go back to work and do productive things and help create more employment by working, and bring the downtowns back to life and those kinds of things. We've got a lot of opportunities here to get this fixed, and I don't think a recession in terms of lowering demand will necessarily create a lot of unemployment, because we've got this huge labor shortage. I mean, it takes a lot of reduction of demand to eat through the labor shortage first. And we also have production issues, because of this labor shortage. If you want to get the supply chain working again, you need to bring everybody back to work. And so, this asset bubble has completely distorted the U.S. economy. And it's really very helpful, I think, to go back to some kind of normal, in terms of people working for a living and asset prices being somewhere reasonable, and people not counting on next year making 100% on their cryptos, but using their brains to accomplish something real. And so I think all of these things are good things. Now there'll be investors who will lose a lot of money, and bond investors. I'm not too worried about credit risk right now, because a lot of these companies have refinanced their debts. And so there's a maturity wall. So when these debts mature, but it's been pushed way out. So now during this low interest rate era, so we're not looking at massive numbers of companies that have to refinance massive numbers of debts over the next year or two. They're looking at 5, 6, 7 years down the road. So we'll be through that rough spot by the time they have to refinance the debts, and that's an issue. That's an issue in other economies, but in this economy here with zero interest rates, so long, everybody's borrowed for as long as possible, refinance their debts and stuff. So, that's much smaller of an issue than it was. At the same time, there will be restructurings, and that's bondholders that are losing their money, and equity holders, and that's okay. That's what happens. You get paid to take those risks, and then there's a payday at some point.
Yeah. Although I think people have become so accustomed to the Fed put that I think many of them just don't believe that they could actually take losses like that. But you and I think share the same mindset. Anything that gets us back to return to freer and fairer and more rationally priced markets is a good thing. Anything that puts the U.S. Gets U.S. resources working towards true productivity is a good thing. So anyways, I appreciate your answer, because the way I look at it is to really deal with the inflation that we've been worried about for such a long time. The Fed is going to have to pump the brakes. That is going to depress asset prices in these overvalued markets, and it is going to impact the economy. My concern is that it might be a really big market correction, which could then trigger a large recession. And you have these overleveraged companies that we talked about. Higher interest rates might cause a number of them to go out of business, which may create a workforce shrinkage right when a bunch of people are trying to come back to work. Sounds like you're not quite as worried as I, so it's nice to hear that optimism. And while the poor worker has been a long sufferer in this journey over the past number of decades, if that indeed does happen, where people are going back to work and kind of competing harder for those jobs, that should reduce wage price inflation pressures, which isn't necessarily great for the worker, but it should take some of the steam off of the overall inflation rate. So many interesting cross currents going on here. Wolf, as we wrap up here, for folks that are watching that are just trying to navigate what we're going through here, do you have any general advice for watchers in terms of how they can hopefully make themselves a little bit less vulnerable to the implications of this higher inflation you see?
Yeah, I think this is a really good time to dial back on risk. And I really don't like bonds right now. The yields are so low, so you're not making any money, and you have a huge problem with bonds when rates go up, because that's when bond prices go down. And so that's where the bond vigilantes came out of during the run up in inflation in the 1970s. The bondholders just got hammered, by relatively low yields and relatively high inflation. And then when the yields turned around, when actually inflation got vanquished and were reduced, the bondholders said, no, forget it. We're not playing this game. We're going to keep prices high and keep yields high and prices low in those bonds. And that's the so-called bond vigilantes. That got burned for 10 years, and those bondholders. And then that got really upset and didn't play the game anymore for a long time. And this is what we're going to run into again this year. I think there'll be many years when bondholders will just get burned year after year after year. It'll be just a really by inflation, by higher yields, which cause prices to go down, and by yields that are still below the rate of inflation. When I say back off of risk, I don't mean go to bonds. That's long-term bonds are very risky in this kind of environment.
Yeah, let me just dig into that just a tiny bit more. So back off of risk. The easiest way to do that is just sell some of your market exposure and just sit in cash. Obviously, people then worry about being in cash in an inflationary regime and having the purchase power eroded from that. So I guess two questions. One, thoughts on cash, and two, are there any general asset classes that you think might perform favorably, or at least favorably on a relative basis in this market environment?
Yeah, so it's true that holding cash loses you, 6%, 7%, 8% a year. But you got to also remember that, if you hold any other asset denominated in dollars, you're going to lose the same amount, but you might make some return on that asset. So you're hoping to make a return to make up for the loss in purchasing power of that asset. So that works if there's a return. But if there's no return, you're holding cash, you're losing 6%. You're holding stocks, and they're going down 50%. Well, now you lost 50% plus the loss of the purchasing power. So that's the risk. The same with bonds, and the same with real estate and all the others. The problem is that the purchasing power loss is spread across all assets, and it's additive if the asset itself loses value. So you have two risks there. The thing is that in an inflationary environment, if it's just inflation, housing and stocks are not bad. They're pretty good investments generally. But when you have a crackdown on inflation, those two classes turn really sour. And very quickly, when you have interest rates that are going up, and when liquidity is thrown out of the market, both those asset classes are tough. And so this hedge, looking for the hedge to hedge against inflation, that gets very tough in an environment where interest rates are going up and where the Fed is starting to crack down on inflation. I don't know that there is really a surefire good option out of this. I mean, if the Fed refused to do anything about it, just sit on its hand forever, I would say stocks and real estate probably are probably a place to be. But the Fed is cracking down. I mean, they're getting very nervous down the political pressure to crack down, and they see what's going on now. Yeah, so I don't think that option of the Fed not doing anything is there. I think cash is probably. People talk about gold, and gold has held up reasonably well. It's had a great run over the past few years. I'm not a fan of gold at this price. I'm not a fan of cryptos at all. I mean, Bitcoin's already down 25+% over the last month. So that's not a hedge against inflation. So you're looking at all these different asset classes, and it's just a nasty place to be right now.
All right. Well, I hate to end on that note, but I think you're just giving the realist view right now in terms of where we are in the current situation. So, Wolf, for folks that want to, so first, thanks for coming on. I want to have you back on again periodically to check in on this as the road becomes a little clearer to us as we get a little bit further down it. But for folks that have enjoyed listening to you today and would like to follow your thoughts on a regular basis, where can they go to follow you?
wolfstreet.com. Everything is free, no paywall. So just come on by. All finance and economics, no politics.
All right, great. And I'll put the URL to your website over the screen here when we edit this. Wolf, thanks so much for coming on. Look forward to having you back on again soon.
Thank you, Adam.
We hope you've enjoyed this discussion with macro analyst Wolf Richter. As he and I mentioned, it's an incredibly treacherous time for individual investors right now. So if you'd appreciate a free, no strings attached portfolio review by a financial advisor who can help manage your portfolio with the risks that Wolf has highlighted here, just go to Wealthion.com and we'll help set one up for you. And if you'd like to see more great experts like Wolf on this program, please just take 2 seconds to support this channel by hitting the like button and then clicking the subscribe button below, as well as that little bell icon right next to it if you haven't already. Thanks for doing that, and thanks for watching.